Welcome to Griffonomics. Today, FedEx Freight Holding Company, trading under the ticker FDXF. FedEx Freight is executing a highly profitable corporate separation that prioritizes pure-play LTL yield quality over empty commodity volume, carving out a dominant 17% market share backed by irreplaceable national real estate. However, this strategic transition creates a temporary structural tension, artificially compressing near-term GAAP operating margins under a $750 million transformation expense peak while establishing the absolute cleanest line of sight to massive cyclical operating leverage.
Yeah. So, and to translate all of that formal thesis into like a real world scenario for you listening, imagine you own this massive, highly lucrative apartment complex.
Right, like a sprawling real estate empire where the rent checks are just, clearing every single month.
Exactly. And the underlying value of the land is just astronomical. But then one month you decide to completely upgrade the entire property.
So you go in and replace every single roof, rewire the electrical grids, maybe hire an entirely new dedicated management staff.
Yeah, you replace the old property manager, and when that specific month ends, your accounting software generates a report that says you are deeply, deeply in the red.
I mean, naturally, because of all the upfront renovation costs.
Right. So a casual observer, just glancing at that single month cash flow statement, might assume your real estate empire is collapsing.
But you know the truth, right? Because next month, those renovation bills just vanish, but the newly elevated rent checks keep rolling in forever.
Exactly. And that dynamic is the precise mechanic driving one of the most fascinating market dislocations we've seen in the industrial sector this year.
So basically today, Wall Street computer algorithms are looking at a broken roof on an earnings report and completely missing the gold mine underneath.
Yeah, it all boils down to a fundamental misinterpretation of financial data by automated trading models versus, human allocators.
And to figure out how to navigate that dislocation, we have pulled together a massive stack of sources for you.
Because if you really want to understand the mechanics of this spinoff, you can't just glance at a headline. You really have to dig in.
Right. So for you, the listener, we've gathered the Q4 fiscal 2026 earnings transcript, the highly detailed investor presentation slides, and several elite institutional deep dive analyses.
Yeah, and our mission in this deep dive is to investigate exactly why generalist Wall Street algorithms and momentum traders are just fleeing in panic from a stock that the absolute top-tier research desks consider a high-conviction strong buy.
We're going to bridge that gap in perception and show you the underlying reality of this standalone debut.
But to truly bridge that gap, we have to start by establishing some operational context, I think.
Okay, let's do it.
Because the term pure play LTL is thrown around in these reports, and for a generalist, it might just sound like corporate jargon.
Yeah, LTL stands for less than truckload.
Right. And before we even look at the financial math, we need to understand the physical reality of what this company actually does.
Because it is vastly different from the FedEx parcel delivery trucks you see driving around your neighborhood.
Completely different. If the parcel business is about moving a 2-pound shoebox from a warehouse to a residential porch.
The LTL business is a whole different beast.
Yeah, it's about moving a 900-pound pallet of tractor engine parts from a manufacturing plant in Ohio to an assembly line in Texas.
Or a dozen pallets of industrial chemicals.
Exactly. Or a large shipment of retail display cases. It's freight that is too big, too heavy, or just too oddly shaped for the standard parcel network.
But it's not quite large enough to require an entire dedicated 53-foot semi-truck all to itself, right?
Precisely. So the customer only wants to pay for the space they actually use.
And that makes sense. If their pallets only take up 1/3 of the trailer, they only want to pay for 1/3 of the trailer.
Right, but that creates an incredible engineering and logistical challenge. Because a full truckload carrier just backs an empty trailer up to a factory, the factory fills it up, and the driver takes it straight to the destination.
Right, point A to point B. It's simple.
Super simple. But an LTL carrier has to pick up freight from dozens of different customers in a local area, bring all that disparate freight back to a central terminal, and sort it.
Like a giant game of 3D Tetris.
Exactly. You have to combine it with other shipments heading in the same direction, pack the trailer, drive it to another hub, unpack it, resort it.
And then deliver it to dozens of different final destinations.
Yeah, it's a highly intricate hub-and-spoke web.
And that complexity is precisely why the barriers to entry in the LTL market are so astronomically high.
Yeah.
I mean, you can't just buy 5 trucks and start an LTL network.
No, absolutely not. You need specialized terminals with dozens, sometimes hundreds of loading dock doors to facilitate that constant cross-docking and sorting.
And for decades, FedEx Freight was the undisputed volume king of this
Yeah.
space. But they were buried deep inside the corporate umbrella of FedEx Corporation.
Yeah, they were treated as a subsidiary, just a cog in a much larger $90 billion conglomerate machine.
Which brings us to the panic. We really need to look at what the trading algorithms are seeing.
Right, why these momentum managers are so terrified of the initial standalone numbers coming out of the Q4 fiscal 2026 print.
Because if you just look at the raw data, like the surface level numbers of this newly independent company, it looks like a disaster.
It really does. If you are an algorithm just scraping the headline GAAP numbers, and let's define that, GAAP stands for Generally Accepted Accounting Principles.
Which is the standardized way companies must report their financials to the SEC.
Exactly. If you're scraping that, you are going to see a massive glaring red flag. Because for the 3 months ended May 31st, 2026, the GAAP operating income for FedEx Freight plummeted to $158 million.
Okay, let's unpack this. Let's put that $158 million in context.
Yeah, for an industrial transport leader of this massive scale, operating hundreds of facilities, generating only $158 million in operating income, drags their operating margin down to a severely compressed 6.6%.
Wow, 6.6%.
Right. So if you're a generalist computer model looking at historical baselines for premium logistics companies, a 6.6% margin looks like the wheels are literally falling off the trucks.
I mean, I would panic too. So the central anchor of the bearish narrative right now is the assumption that standing up an independent operation is inherently destroying the company's profitability.
That's exactly what they think. The automated models see that 6.6%, and they price in structural decay. They assume the business itself is failing.
But this is where critical thinking becomes your biggest advantage, right? We have to look at the non-recurring add-backs.
Yes, because that 6.6% margin is artificially suffocated by a massive one-time $205 million charge.
The $205 million charge specifically for front-end standalone spin-off transaction and IT separation costs.
Right.
Let's really pause here and apply the ELI 5 rule. Explain it like I'm 5. What exactly does a $205 million separation cost actually buy in the real world?
Well, they aren't just paying lawyers to draft new corporate charters, I can tell you that. It is essentially the cost of performing a corporate organ transplant while the patient is running a marathon.
Oh, wow, that's a great way to put it.
Yeah, FedEx Freight had to completely sever its digital umbilical cord from the parent company so that $205 million paid for separating over 1,000 deeply integrated corporate software applications.
1,000 applications.
Yeah. And it paid for migrating 17,000 separate mobile devices, scanners, and terminal computers into a brand new standalone cloud environment.
Not to mention standing up independent human resources systems, independent payroll architectures, and independent cybersecurity perimeters.
Exactly. It's a massive undertaking.
And the institutional sources point out something truly incredible about this process. They executed this day one systems cutover with zero operational breakage.
Think about the magnitude of that achievement. We are talking about a network with nearly 30,000 motorized vehicles moving thousands of tons of freight every single hour.
Right. In the logistics world, IT migrations are historically fraught with disaster.
Oh, absolutely. We've seen massive retailers and airlines literally grind to a halt, losing packages, stranding passengers.
Collapsing billing systems just from upgrading their internal software.
Exactly. And FedEx Freight, completely uncoupled from a global conglomerate without a single significant disruption to the physical movement of freight.
So if you're an investor looking at your screen, you shouldn't view that $205 million as a penalty. You should view it as the ultimate down payment on their independence.
Precisely. And when you perform a forensic audit of the regulatory disclosures and strip out that non-recurring administrative noise, you pull back the curtain on the normalized reality.
The accounting math here is vital.
It is, because when you add that $205 million back to the depressed $158 million GAAP figure, you reveal the actual underlying cash generation of the business.
Which is what?
The actual adjusted operating income is $363 million.
Which is a spectacular jump.
Yeah, it is. And to put that in margin terms, that $363 million translates to a stellar 15.1% adjusted operating margin.
Okay, so the core underlying logistics machine, the actual business of loading a pallet onto a truck and delivering it to a warehouse, remains a remarkably high margin.
Yes. The 6.6% is an accounting illusion driven by the renovation costs. The 15.1% is the reality of the freight moving through the network.
Got it. And the nuance doesn't stop there, does it?
No, to truly audit this margin expansion, we have to reconcile this core baseline capacity against the prior year period.
Right, we have to factor in some distinct accounting artifacts that make the year-over-year comparison look artificially worse than it actually is.
Exactly. For instance, the company is lapping a $33 million facility sale gain from fiscal 2025.
Okay, let's translate that. Lapping a gain means that in the exact same quarter last year, they happened to sell a piece of physical real estate. Right.
Right, maybe an old terminal they didn't need anymore. And they recorded a $33 million pure profit on that sale.
So that one-time sale puffed up last year's numbers. This year, they didn't sell a building.
Yeah, so just to show a year-over-year tie, they have to run the core trucking business $33 million better just to make up for the lack of a real estate sale.
That's a huge headwind to overcome.
It is. And furthermore, they have the structural insertion of newly allocated independent operational headcounts.
What does that mean exactly?
Well, when they were part of FedEx Corp, they shared back office staff. Now, they had to go out and hire their own dedicated HR department, their own legal team, and their own dedicated sales force.
Right, so that is a permanent new baseline of salaries they have to absorb.
Exactly.
So let's synthesize that. They absorbed the cost of an entirely new corporate headcount. They didn't have the benefit of a $33 million real estate windfall like they did last year. And they still managed to generate a 15.1% adjusted margin on the actual freight operations.
Which demonstrates that the underlying cash engine is incredibly robust. Generalist market models are fleeing from a ghost.
The margin collapse is purely an optical illusion.
Completely.
Okay, so the margin illusion is solved. But that brings us to the next massive question, right? The second vector of panic.
Right, the macro environment.
Yeah, if the business is running efficiently on a unit economics basis, how are they surviving the broader macroeconomic freight softness? Because if you look at the macro indicators across the entire logistics sector, the freight market is not exactly booming right now.
No, it is currently operating in a protracted cyclical trough. And generalist models are inherently terrified of cyclical volume dips.
They look at industrial production metrics, they look at inventory destocking, and they get nervous.
Exactly. For FedEx Freight specifically, they are pointing very aggressively to a specific metric from the Q4 report, a 5.9% year-over-year decline in average daily shipments.
Wait, a 5.9% drop in daily shipments. If I'm an investor listening to this, and I look at my portfolio, a 5.9% drop in volume usually means one thing. The management team is losing market share to competitors.
Yeah, Wall Street punishes companies for shrinking.
So prove to me that this is intentional. Prove to me they aren't just losing the battle for customers out there.
What's fascinating here is the distinction between intentional curation versus accidental shrinkage. To understand why this 5.9% drop is not a failure but a strategic masterstroke, we have to look at the history of how FedEx Freight was utilized by its parent company.
Okay, let's dig into that history.
When they were deeply embedded inside the FedEx corporate umbrella, the LTL network was often used as a loss leader or a bundled sweetener.
Explain how that bundling works in practice for us.
Sure. Imagine a massive enterprise customer, let's say a global electronics manufacturer. FedEx Corporation wants to secure the contract to deliver millions of tiny parcel packages for this manufacturer.
Right, the high-volume, lucrative stuff.
Exactly. To win that highly lucrative parcel contract, the corporate salespeople would say, hey, if you give us your parcel business, we will also take all your heavy, bulky LTL freight at a massive discount.
So they were essentially subsidizing the parent company's parcel business by accepting heavy freight at rock-bottom rates.
Yeah, they were filling the LTL trailers with cheap commodity freight just to keep the overarching corporate client happy. The legacy strategy was essentially maintain volume at all costs.
Wow. But now, as an independent, pure-play LTL carrier, that mandate has fundamentally shifted, hasn't it?
Totally. They no longer have to subsidize the parcel division. They are operating with extreme yield discipline. They're executing what the institutional research desks call a yield counterattack.
I want to dive deep into the mechanics of this counterattack because the math they are pulling off is just staggering. The macro volume headwind, that 5.9% slide in average daily shipments, was completely neutralized by their newfound pricing power.
Absolutely neutralized. Revenue per shipment surged an elite 11.5% year over year to $415.22.
And it wasn't just temporary fuel surcharges driving that number up, right? I mean, fuel is a pass-through cost that plays a minor role.
Right, we have to look at a metric called revenue per hundredweight. In the LTL industry, weight is money.
So revenue per hundredweight measures exactly how much yield they extract for every 100 pounds of freight placed on their trailers.
Exactly. And that metric expanded 8.2% to $43.79. At the same time, the average weight per shipment grew 3.0% to 948 pounds.
Okay, let's use an analogy here to make this crystal clear for everyone. It's like a massive 500-seat restaurant that realizes its $5 value menu burgers are keeping the dining room completely full, but the profit margin on a $5 burger is just pennies.
Right. The kitchen is frantic, the waiters are exhausted, the tables are suffering wear and tear, and at the end of the night, the cash register is mostly full of ones and fives.
Exactly. So management makes a radical decision. They completely scrap the value menu. They transition to a premium steakhouse model, focusing entirely on selling $50 steaks.
The immediate result is that the total number of customers walking through the door drops. You lose the bargain hunters.
Right, so your volume goes down by 5.9%.
But the patrons who stay are paying $50 a plate. You have fewer tables to bus, less wear and tear on your dining room, and your kitchen can actually focus on quality instead of frantic volume.
Your total revenue goes up, and your profit margins absolutely skyrocket because the steaks are so much more lucrative.
That is exactly what FedEx Freight is doing. They are systematically rewriting legacy parent contracts onto standalone one-year LTL parameters.
They are unbundling the pricing and intentionally letting the low-margin commodity freight just walk out the door.
Yeah, they are letting that low-value freight go to regional competitors who are still willing to race to the bottom on price just to keep their trucks moving.
And the most remarkable part of this transition, the data point that truly validates this strategy, is the customer reaction rate.
It is, because management has observed zero significant contract breakage or customer friction as they unbundle these accounts.
Wait, if they are intentionally shedding 5.9% of their daily shipments, aren't they just shrinking the business?
Yeah.
And if you are a logistics company and you walk into a client's office and say, hey, we are raising your rates by 11.5% and unbundling your discounts, human nature suggests the client is going to be furious.
You would think so, right? They are going to shop around.
How are they achieving zero friction?
It speaks to the undeniable quality of the service they provide and the massive upgrade in their commercial strategy. They aren't just raising prices, they are drastically improving the value proposition.
Yeah.
In fact, their Mastio customer experience scores, which, for those unfamiliar, is the absolute gold standard, third-party metric for measuring customer satisfaction in the shipping industry, actually jumped 8% quarter over quarter right in the middle of this pricing transition.
So they are charging more, taking on heavier, more complex freight, and the customers are actually happier. How do you raise prices and improve satisfaction simultaneously?
Because, for the first time in their history, they have a fully staffed, 500-person dedicated LTL sales force.
Ah, okay. Under the old regime, the salesperson visiting the client was a generalist.
Right. They were trying to sell overseas air freight, ground parcel, and heavy LTL all at the same time. Now, the salesperson walking into that office is a deeply specialized LTL expert.
They look at the client's supply chain and introduce fit-for-purpose LTL solutions.
Exactly. They are improving billing accuracy, rolling out a modernized, transparent pricing system, and giving customers a highly consultative experience.
And when a manufacturer knows their critical 900-pound engine part will arrive exactly when promised, without damage, they are more than willing to pay a premium yield. Reliability is worth the extra cost.
Yeah, it sets up a fascinating dynamic. They have structurally higher margins on lower, denser volume.
But here is where we need to put on our forensic accounting hats again. Because management is actively reshaping their customer base and rewriting these contracts right now in real time. How does this play out over the remainder of the year?
We really need to perform a strict audit of their financial guidance for that.
Because the spin-off forced them to align their fiscal calendar with the standard calendar year, creating a very strange, truncated 7-month transition period.
Yeah, this transition period covers June 1st to December 31st, 2026. And this specific 7-month window is exactly where the generalist models the algorithms that just extrapolate averages are making a massive, verifiable miscalculation.
The institutional sources call this the middle market blind spot.
Right. So let's lay out the raw framework of the guidance first. For this specific 7-month window, management has publicly targeted between $605 million and $645 million in adjusted operating income.
And they expect revenue growth in the range of 4% to 6%.
Yeah, so if you are a lazy algorithm, you take that $605 million, divide it by 7 months, and assume the company will generate roughly $86 million in profit every single month.
But the physical reality of the freight industry absolutely shatters that linear assumption, right?
Oh, totally. The LTL market is intensely seasonal. Management had to explicitly warn the street on the earnings call that this 7-month guidance is massively front-loaded.
Right. Approximately 75% of that guided adjusted operating income and 60% of the revenue growth is going to be generated entirely in the 4 months ending September 30.
75% of the profit crammed into just 4 months.
Let's explain why the freight calendar works this way. Why is the summer and early fall such a massive cash machine for LTL?
Well, it comes down to industrial rhythms and inventory cycles. During the summer, construction and manufacturing are at peak capacity, moving heavy materials across the country.
And then, in late summer and early fall, retailers begin the massive pull forward of inventory to stock their distribution centers ahead of the holiday shopping season.
Exactly. They are moving thousands of pallets of electronics, apparel, and consumer goods. Furthermore, the summer months physically contain more operational business days.
And what happens after September 30th?
The seasonality drops off a cliff. The back half of the transition period, October through December, contains Thanksgiving, Christmas, and New Year's. Entire manufacturing plants shut down for weeks.
The number of active shipping days just plummets.
Yeah. Additionally, standard corporate merit pay increases for the workforce typically hit the books in the fall, artificially raising expenses right as volume dips.
So if you're listening to this and tracking the stock, what does this extreme seasonality mean for the investment thesis?
It means that FedEx Freight is structurally setting up an imminent, massive sequential data beat for the September quarter.
Wow.
Yeah, the broader market models are still expecting a smoothed out average. When those September numbers actually drop, reflecting the peak summer load, they are going to look incredibly strong compared to the algorithmic expectation.
The smart money is positioning for this exact data anomaly.
Exactly.
But even with that front-loaded revenue beat, we have to acknowledge that the overall operating ratio for the transition period is still carrying a heavy backpack. Let's dissect the specific margin headwinds dragging down these transition numbers, because even though they are printing cash, they are still paying the toll for the spin-off.
Right. There are two main structural headwinds artificially compressing the adjusted operating margin for the specific 7-month period.
Okay, what's the first one?
First, there is a 120 basis point drag, which translates to roughly $65 million coming directly from ongoing transition service agreements, or TSAs.
For those not staring at a Bloomberg terminal every day, let's translate 120 basis points. A basis point is just 1/100 of a percentage point. So 120 basis points means 1.2%.
Right. They are losing 1.2% of their total profit margin specifically to these TSAs.
What exactly is a transition service agreement in a corporate spinoff?
When you sever a company of this size, you can't build every single internal system overnight. While FedEx Freight successively migrated the critical operational tech, they still rely on the parent company for certain complex back-office administrative functions.
Like what? Specialized international tax compliance or legacy pension administration?
Exactly. A TSA is a formal contract where the newly independent company pays the former parent company to continue providing those specific services for a temporary set period of time while they build their own permanent internal capabilities.
It's kind of like moving out of your parents' house, but paying your mom a monthly fee to keep doing your taxes for the first year while you figure out how the software works.
That's a perfect analogy. It's a necessary expense, but it is purely temporary.
And what's the second major headwind?
It's an additional 130 basis point drag, or 1.3%, related to performance-based compensation.
Because as an independent company, they had to establish new, standalone incentive structures to retain key talent and align management's pay with the new profitability metrics.
Exactly. And when you combine the TSAs, the compensation adjustments, and the ongoing IT modernization, the total cost of this transformation is staggering.
Yeah, during the Q&A portion of the earnings call, analysts pressed management on the peak cost of all this friction. Management clarified that the annualized transformation costs will run north of $600 million, and are expected to hit a definitive peak somewhere between $700 million and $750 million.
That $750 million figure is the peak of the mountain, and this is the critical divergence between the retail narrative and the institutional thesis.
Momentum traders see a $750 million expense peak and project it forward into infinity.
Right. They price the stock as if FedEx Freight will carry that burden forever.
Yeah.
But the elite research models recognize that this is a temporary mountain they are climbing.
Management has been crystal clear on this.
Yeah.
As the TSAs expire and the tech modernization is completed, these costs will begin to rapidly collapse in the back half of 2027.
Exactly.
So let's synthesize the journey so far. We've proven that the initial 6.6% margin collapse is an accounting illusion caused by the one-time $205 million spin-off cost.
Yes.
We've proven that the 5.9% volume decline is actually a highly profitable unbundling of cheap commodity freight replaced by premium yields.
Correct.
And we've proven that the massive $750 million transformation expense is going to peak and then vanish by late 2027.
Which leaves us with the core truth. An incredibly disciplined, highly profitable cash engine just waiting to be unleashed.
But if you're listening to this and evaluating the long-term viability of the business, you have to ask a deeper question about defense. Sure, they are optimizing their pricing right now, but what happens when the broader macro environment finally turns?
Right. What happens when the industrial recession ends and the freight market explodes into a true cyclical upcycle?
Yeah, to consistently capture this high-yield freight and defend against competitors, what physical and technological assets does FedEx Freight actually possess?
Yeah.
What is their actual competitive moat?
Well, the structural assets they control are not just impressive, they are arguably impossible to replicate in modern North America.
Impossible.
Yeah, they are currently operating over 365 locations with a massive 26,000 service center doors across the continent.
26,000 doors. Let's unpack why that is the ultimate trump card. Because in the LTL industry, the door is the bottleneck of profit, isn't it?
Oh, absolutely. A door is exactly what it sounds like, the physical bay at a terminal where a truck backs up to load or unload freight. You simply cannot build a competing network of that density from scratch today.
You really can't. If a well-funded startup with $1 billion tried to recreate FedEx Freight's network tomorrow, they would hit a brick wall.
The zoning laws alone.
Right, the municipal environmental impact studies,
Yeah.
the severe NIMBism, not in my backyard against industrial truck terminals.
And just the sheer skyrocketing cost of premium industrial real estate near major highway arteries, it makes it functionally impossible to secure 26,000 new doors.
FedEx Freight acquired this real estate decades ago, expanding through legacy acquisitions like American Freightways and Watkins Motor Lines.
Yeah, they locked in these prime locations before the modern e-commerce boom made industrial land prohibitively expensive. They hold an unassailable, asset-dense, irreplaceable real estate monopoly.
And what's even more powerful for the near-term investment case is how intentionally underutilized that network currently is.
This brings us to what the institutional analysts are calling the zero capex scale vector.
Right now, management has engineered the network to sit on a massive 30% spare facility capacity buffer.
Let's contextualize why a 30% empty buffer is a weapon, not a weakness. I was reading the transcript, and CEO John Smith made a statement that should make any institutional allocator immediately adjust their models.
What do you say?
He stated clearly, right now, we could add another 10,000 shipments and not have to buy a piece of new equipment.
10,000 new daily shipments without deploying a single dollar of new equipment capex. That's insane.
It is. Let's explain the mechanics of incremental margin for the listeners. In a normal business, if you want to increase your output by 10,000 units, you have to build a new factory, hire new workers, and buy new machines.
Right, so your profit margin on those new units is dragged down by the massive capital expenditure required to produce them.
But FedEx Freight already owns the terminals. They already own the doors. They already have the 17,000 tractors fully depreciated and ready to roll.
So if the industrial economy accelerates tomorrow and 10,000 new daily shipments flood into the market, FedEx Freight can absorb them instantly.
Instantly. And because the fixed costs are already paid for, those 10,000 shipments flow through the network at near 100% incremental margin.
Wow. Every single extra dollar of revenue from those new shipments essentially falls straight past the operating expenses and lands directly on the bottom line. It is the purest definition of cyclical operating leverage.
And they are capturing this high-yield freight using a highly unique dual-service model.
Right, they are the only major LTL carrier offering both a priority service and an economy service simultaneously.
This dual model is a massive competitive advantage. The priority service is engineered for speed-focused, time-sensitive deliveries.
Think medical supplies or critical manufacturing components where the assembly line stops if the part doesn't arrive.
Exactly. Based on trailing 12-month data, this priority service operates roughly 40% faster than their nearest direct competitor.
And the economy service, on the other hand, is value-focused.
Right. It offers flexible time deliveries for customers who want a lower rate and don't need overnight speed.
But here is the operational genius. They run both of these distinct services using the exact same trucks, the exact same dock doors, and the exact same drivers.
The engineering required to balance that is just staggering. They use the priority freight to dictate the rigid, high-speed line haul schedules overnight.
Then, they use the economy freight to fill in the empty gaps.
Yeah. The flexible economy freight optimizes the network by spreading operations across daytime hub windows when the terminals would otherwise be quiet.
And it allows them to leverage cheaper intermodal rail transport for the long-haul segments. It gives customers the ultimate choice trade-up for speed or maximize value without the company having to compromise its own margins by running two separate redundant networks.
So we have an impenetrable real estate moat and a highly engineered dual service model.
But the physical real estate is only half of the story. We also have to explore the hidden technological option value buried deep inside this company.
Automated trading systems completely ignore long-tail technological updates, but FedEx Freight is quietly leveraging advanced tech to scrub structural costs off their balance sheet right now.
This is a perfect example of how the narrative around automation is often misunderstood by the broader market.
Right. When people hear autonomous trucking, they picture a sci-fi future empty cabs driving down the interstate, a concept that is consistently delayed by severe regulatory hurdles and political pushback.
Generalist investors assume autonomous tech won't impact profit margins for another decade.
But the reality on the ground at FedEx Freight is drastically different. They aren't waiting for a legislative miracle. They have already verified 99.9% hands-free interfacility terminal navigation.
Let's explain what that means. While highway autonomy is stalled, FedEx Freight focused their R&D on the private property they already control, the massive yards surrounding their terminals.
Yeah, years of testing their autonomous line haul program have proven that the technology can navigate a massive tractor trailer from the parking yard directly to the loading dock door without human intervention 99.9% of the time.
This yard automation drastically reduces the time human drivers spend maneuvering in congested, low-speed environments, right?
Exactly. Maximizing their allowable hours of service for actual highway transit.
So what does this all mean for the bottom line today? We always hear about autonomous trucks as a future sci-fi concept, but how is it saving them cash right now?
Because the sensors, cameras, and predictive software developed for the autonomous program don't have to wait for driverless approval. They've taken that exact same technology and packaged it as Advanced Driver Assistance Systems, or ADS.
And they have aggressively deployed this ADS suite, which includes advanced collision avoidance, intelligent lane departure warnings, and highly sensitive rollover stability software across their core fleet of 17,000 tractors.
Let's explain how this mechanically stops an accident. Imagine a driver is hauling 40,000 pounds of steel and takes an off-ramp slightly too fast.
In a legacy truck, human reaction time is often too slow to correct the momentum, resulting in a catastrophic rollover.
But with the rollover stability software installed across the FDXF fleet, the truck's internal computer can instantly sense if the trailer is tilting past a specific dangerous degree.
And then what?
In a fraction of a second, the software automatically applies independent braking pressure to specific individual wheels. A maneuver a human foot is physically incapable of performing, instantly stabilizing the trailer and preventing the rollover before it happens.
17,000 tractors armed with that level of automated reflex.
Yeah.
And we can see the direct financial result of this deployment in the SEC filings.
This technology is the direct mechanical driver behind FedEx Freight printing record-low DOT preventable accidents in fiscal 2026.
It is also driving a record-low cargo claims ratio, meaning less customer freight is being damaged in transit.
This is where the tech hits the ledger. By physically stopping accidents before they happen, and by keeping the freight perfectly stable, they are literally scribbing millions of dollars in core insurance liabilities, legal settlements, and cargo damage payouts off their balance sheet today.
While smaller, regional competitors lag behind, relying on older, analog fleets and paying sky-high, escalating insurance premiums, FedEx Freight is structurally lowering its risk profile and widening its profit margin through applied technology.
Which raises the ultimate question for any investor.
Right. We see the highly disciplined cash engine. We see the impenetrable physical real estate moat. We see the automated risk insulation. So what exactly is management going to do with all of this generated capital? Where is this newly found cash physically going right now?
This brings us to capital allocation and what the elite institutional research notes are calling the self-help catch-up playbook.
Because the structural financial power of this standalone entity is frankly massive. Management has confidently laid out a medium-term framework targeted to generate greater than $1.0 billion in annual free cash flow.
Over $1 billion in free cash flow. But what truly stands out in the institutional analysis is the efficiency of that cash generation. They project a net income to free cash flow conversion rate of greater than 90%.
Let's demystify that 90% conversion rate. In heavy industrial businesses, a company might report $100 million in net income on paper, but they have to immediately spend $80 million in that cash on replacing broken equipment or upgrading facilities just to tread water, leaving very little actual free cash.
A greater than 90% conversion rate means that for every dollar of profit FedEx Freight generates on its income statement, 90 cents flows directly into the corporate treasury as unencumbered, usable cash.
It is an elite level of capital efficiency, driven heavily by that 30% empty facility buffer we discussed earlier.
Yeah.
They don't need to spend heavily on new terminals, so the cash just piles up.
That billion-dollar arsenal gives management incredible optionality. But they aren't just going to start throwing money around to appease momentum traders.
Right. If you read the transcripts, the retail market is currently complaining about a lack of immediate stock buybacks. They want the sugar rush today.
But management has outlined a very strict, highly disciplined, sequence-driven capital returns playbook. They are playing the long game.
Exactly. Phase 1 of their playbook, which dictates capital flow for the first 12 months post-spin, explicitly prioritizes the balance sheet.
When FedEx Freight was spun off, it was seeded with a portion of the parent company's debt. Management's immediate mandate is to aggressively pay down that inherited debt to secure and maintain a pristine investment-grade credit rating.
The specific mathematical target is to reduce their gross leverage ratio to a conservative 2.5 times within the first 12 months.
And the benefit of that isn't just a better credit score. By extinguishing that debt, they are going to permanently eliminate approximately $200 million in annualized interest expense.
That's $200 million a year of pure cash flow permanently freed up year after year just by cleaning the house first.
Once that gross leverage hits the 2.5 times target, they move to phase 2.
Which is when?
The timeline for this is targeted for late 2026 or early 2027. Subject to board approval, management plans to formalize and introduce a structural dividend layer, providing a reliable, recurring yield to long-term shareholders.
And then comes phase 3, the catalyst the institutions are waiting for.
Right. In mid to late 2027, precisely when the unbundling of the legacy pricing is 100% complete and the temporary $750 million TSA burden begins to rapidly vanish, they plan to launch aggressive share repurchases.
They will use their billion-dollar cash flow to systematically retire stock on the open market, compressing the share count and forcing earnings per share higher. It is a methodical, step-by-step approach to value creation.
But the real upside, the massive asymmetric alpha vector that makes this stock a strong buy for the elite desks, comes from comparing FedEx Freight to the undisputed industry leader,
Old Dominion Freight Line, trading under the ticker ODFL. Here's where it gets really interesting.
Right. If you're listening to this and wondering if this is such a sure thing, why hasn't the broader market priced it in yet? This comparison is the key.
In the LTL industry, the ultimate scoreboard is the operating ratio, or OR. It simply measures expenses as a percentage of revenue. A lower number means you are vastly more profitable.
Currently, FedEx Freight operates at an adjusted operating ratio of roughly 88.5%. It costs them 88.5 cents to generate $1 of revenue.
And Old Dominion, the gold standard, runs at a remarkably lean operating ratio of approximately 75%.
That creates a glaring 1,000 basis point gap in profitability between FedEx Freight and the industry leader.
And Wall Street, particularly the generalist momentum algorithms, is looking at that 1,000 basis point gap and treating it as a permanent structural flaw.
They assume FedEx Freight's network is inherently bloated and will never catch up to Old Dominion. Therefore, they assign FDXF a permanently lower valuation multiple.
But the deep dive institutional analysts frame this entirely differently. They look at that 1,000 basis point gap not as a permanent failure, but as a massive self-help alpha vector.
They see 1,000 basis points of pure, controllable opportunity that management can execute on regardless of what the macroeconomy does.
Jefferies, for instance, firmly underwrites a highly credible 350 basis point margin catch-up campaign.
They don't expect FDXF to match Old Dominion's 75% overnight, but they mathematically model that FedEx Freight can improve its operating ratio from 88.5% down to an 85% OR by 2029.
And to prove this isn't just Wall Street spreadsheet magic, we have to look at the history of the executives running the company.
Right, we have to ask, how exactly are they going to find 350 basis points of savings, and have they ever done it before?
The answer is a resounding yes. CEO John Smith and this exact executive team have a verified historical precedent of executing severe operational turnarounds.
The institutional memory here is crucial. In the 4 years following fiscal year 2018, this exact same management team successfully carved a staggering 1,000 basis points of pure operating waste out of this very network.
And how did they do it in 2018? They didn't just fire people. They structurally re-engineered the freight.
For example, they initiated a massive optimization of trailer cube utilization. They analyzed how dock workers were physically stacking the freight inside the 53-foot trailers.
By using software to build denser, interlocking loads, essentially playing a better game of 3D Tetris, they increased the volume of freight in every single trailer by over 10%.
That meant fewer trucks on the highway, burning less diesel, requiring fewer drivers to move the exact same amount of revenue. That one operational fix drove massive margin expansion.
Exactly. And now they are deploying those same optimization strategies with a newly empowered independent mandate.
They are using their 500-person dedicated sales force to attack a highly lucrative $9 billion premium vertical market.
They are executing aggressive network rationalization, closing redundant terminals, and continuing to invest in that trailer density technology.
So asking this specific management team, a team that already found 1,000 basis points of savings in 2018, to find just another 350 basis points over the next 3 years is not a leap of faith.
No, it is an entirely credible, highly probable baseline scenario.
It is time to synthesize all of these vectors, the accounting math, the yield strategy, the real estate moat, and the capital playbook into the final investment verdict.
What is the ultimate profile of this enterprise, and how should an allocator position themselves?
Well, if you strip away the temporary noise of the spinoff, FedEx Freight is fundamentally acting as a premium industrial toll road.
It is moving the critical raw materials and finished goods that keep the North American economy functioning.
But because of algorithmic misunderstandings regarding GAAP accounting, transition expenses, and intentional volume unbundling, it is currently trading at a deep, unjustified spinoff discount.
For long-term allocators, this represents an unmatched margin of safety.
The summary analogy used across the institutional research is perfect. FedEx Freight represents an unassailable, asset-dense, irreplaceable real estate monopoly.
It just happens to have 17,000 technologically advanced trucks driving between the buildings.
And when we look at the primary institutional valuation coordinates provided in the source material, the conviction across the major desks is remarkably aligned, pointing to significant upside as the market digests the true standalone metrics.
Let's map those specific targets. You have Stifel laying out a highly conservative baseline target of $160 per share, acknowledging the underlying value even in a muted economic environment.
Then you move up to Bank of America, which has modeled a robust $187 re-rating target.
BOFA specifically anchors their thesis on the fact that as those temporary TSA costs inevitably fall away, FDXF will experience multiple conversions.
Right. They will keep pace with the premium valuation multiples awarded to industry leaders like Old Dominion because they have the absolute cleanest line of sight to top-line growth and margin expansion.
And peaking at the top of the consensus, you have Jefferies holding a high-conviction $200 target.
Jefferies bases this aggressive target on applying a 33.5 times valuation multiple to their proprietary 2028 earnings per share estimate of $5.93.
Their core argument is that the current market entry level is a generational discount for acquiring the largest, densest, and most technologically advanced LTL network in North America.
So, synthesizing this down to a tactical action plan for the listener, it requires a disciplined, multi-step approach to exploit the dislocation. First, allocators are advised to exploit the GAAP cost peak right now.
You should systematically accumulate equity throughout this technical bottoming window, while the momentum algorithms continue to confuse non-recurring transformation and IT separation expenses with structural product failure.
Buy the apartment building while the market thinks the roof repair is a permanent expense.
Second, you must front-run the truncated transition load. You want to complete the majority of your core positioning before the broader market realizes that 75% of the guided adjusted operating income is heavily front-loaded into the period ending September 30.
You want your capital fully deployed before that massive sequential data beat hits the wire and forces the automated models to aggressively recalculate.
Finally, hold for pure play multiple convergence. Maintain the long allocation as the broader market finally shifts FDXF away from its historically compressed conglomerate burden valuation.
And appropriately re-rates it as the elite, pure-play industrial toll road it now undeniably is. Critical thinking is absolutely essential here.
While the retail algorithms trade on visual red flags and panic over optical margin compression, the smart money is exploiting the technical indigestion of the spinoff to accumulate an irreplaceable real estate monopoly at a severe discount. Thank you for joining us on this deep dive into Griffonomics and the fascinating standalone debut of FedEx Freight. We've unpacked the GAAP illusions, the yield architecture, the autonomous tech moat, and the massive institutional arbitrage opportunity created by the spinoff. But before we go, I want to leave you with one final, unexplored thread to mull over.
What's that?
We spent a lot of time detailing how FedEx Freight is already seeing immediate massive margin benefits, printing record low DOT accidents, and scrubbing millions in insurance liability payouts simply by installing advanced collision avoidance and rollover stability tech across its 17,000 tractors.
Right. They have the billion-dollar free cash flow to afford that hardware.
So put yourself in the shoes of their competitors. What happens to the rest of the highly fragmented LTL sector when this level of advanced safety technology inevitably becomes a mandatory regulatory baseline for survival on the highway? Will we see a massive catastrophic wave of bankruptcies or forced distressed acquisitions of smaller regional carriers who simply don't have the capital to afford the million-dollar tech upgrades needed to legally compete? Just think about what happens to the industry when the X-ray machine of modern logistics finally demands absolute automated precision and the legacy players realize they're still operating in the dark.